Hey everyone, and welcome to my crash course on the covered call strategy. So in this video here, you're going to learn exactly what the strategy is and how it works, and then also the very important details that go into actually using the strategy. And also this video is broken up into a few key segments, and so in this first segment here, I'll just be talking generally about some of the key concepts of what this strategy is. Now, as always, before we dive in here, in case you are brand new to the channel, my name is Scott Reese, and I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in case you want to see more trading or investing content after watching this video, you can also find me on Skillshare as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for Skillshare using any of those links, you'll get a full 1-month free trial. Okay, so number one here, what exactly is the covered call strategy? Well, essentially this is mostly a bullish strategy, but it also can be viewed as a more directionally neutral strategy as well. And that's because you can actually make money if the stock that you're trading the covered call on moves sideways or ideally moves upwards in price. And essentially, the covered call strategy is a great addition to a more long-term approach to investing in the stock market. So, for example, if you are a buy and holder, if you just like to buy stock and hold for the long term, then again, the covered call is going to be a great addition to that kind of approach. And with the covered call, there are basically two main components to this strategy. You have long stock, or basically shares of stock that you have purchased, and also a short call option, which is basically a call option that you have sold as an opening trade. So focusing first on the first component, what does it mean to actually buy stock? And I think this one is probably pretty obvious. Well, when you buy shares of stock, you are hoping that the price increases over time. It's very simple. And ultimately, that aspect of the covered call, the long stock, that is what gives this strategy mostly a bullish bias to it. Because as you will see in this video, you will actually make the most money with this strategy if the stock price does actually increase over time. Now, what about the second part of the covered call? What does it mean to actually sell a call option as an opening trade? Well, basically, when you do this, you are entering into an agreement with the buyer of the contract that if the stock price is actually above the strike of the call option, by the expiration date, you as the seller of the contract must sell 100 shares of stock at that strike price. So a very basic example of the covered call strategy would be, let's say I buy 100 shares of stock at a price of $50 per share. And then after I do that, I sell a call option with a strike price of 55, just a bit above the purchase price of my stock. And then let's say by the expiration date, the stock price has actually increased above 55, above the strike price. So again, at that point, I will get assigned on the contract, and therefore I must sell my shares at that price, at 55. But if you do the basic math on this, then you will see that this is actually going to be a good outcome because I basically bought the shares at 50 and then I sold them for a higher price at 55. So that's going to be a profit of $5 per share times the 100 shares. That's a total profit on the stock of $500. But then also, no matter what happens by the expiration date, you will still always get to keep the premium that you sold the call option for at the beginning of the trade. So again, with our example here, let's say I sold that 55 strike call option for $300. Then again, no matter what happens by the expiration date, if I get assigned on it, or if the option simply expires worthless, I always get to keep that $300. So therefore, the $500 I made on the stock gets added to the $300 in premium that I keep from the call option. And that makes the total profit in this situation of $800. And as you will see, the premium that you sell this call option for, this is actually what allows the entire strategy to still make money even if the stock simply trades sideways. And again, that's also why the covered call can also be viewed as a directionally neutral strategy as well. Right? So for example, let's say you buy the shares at a price of 50, and then by the expiration date of the call option, the stock is still at a price of 50. So therefore, that call option is going to expire worthless. It's not going to be useful for the buyer of the contract because again, that option is only useful if the stock is above the strike price. So in this case, you don't make any money from the stock position, but again, you still always get to keep the premium, that $300 that you sold the call option for. So even in this case, with the stock going nowhere in price, you still made $300. And so with that being said, hopefully that should give you a very generalized understanding of what the covered call strategy is and how it works. Now we're going to jump on over to thinkorswim here, and we're going to dive into some very detailed examples using Snapchat. And then also I'll be discussing some other very important concepts like implied volatility, which expiration and strike should you choose, cost basis, and all that good stuff. Okay, so the stock I'll be using in our examples is going to be Snapchat, and there's a few reasons for that. Number one, if we come over here, and I'll zoom in a little bit, this stock has definitely gotten killed over the past couple months here. And as I explained, the covered call strategy is mostly a bullish strategy. So ideally, you want to use it on a stock that perhaps has been going through a bit of a sell-off and is now perhaps oversold. And therefore, you might think that there's a good chance for the stock to recover. So as you can see here, Snapchat fell from a high of just over 83 bucks per share all the way now down to about 36 bucks per share. So that's a drop of over 50%. So again, if you were to ask me what kind of stock I would be looking at for a cover call strategy, I would definitely look at something like Snapchat here. Now, the second major reason why I chose Snapchat here has to do with implied volatility. And this is a very important aspect of the cover call, or pretty much any option selling strategy. Now, in case you are not aware of what implied volatility is, it is simply the projected future price range of any particular stock that you're looking at. So for example, if we come down here to this chart, let me expand it up a little bit. So this chart down here is showing you the implied volatility for Snapchat over the past 1 year. And right now, the current value for the IV is just over 87%. And so the way you interpret this number is 1 year from today, because by default, when you look up the IV in your platform, it's typically quoted on a 1 year time frame. So again, 1 year from today, the market is currently expecting Snapchat to be either up or down by about 87%. And that's obviously a pretty wide range. So Snapchat is typically a more volatile stock. It tends to go through very large price swings. And so again, that's why oftentimes you see the IV being pretty high as well, or basically the future expected price range being very wide. And then as you can see here, the implied volatility for Snapchat, and any stock for that matter, does fluctuate quite a bit. So basically, depending on what's happening now with Snapchat and what the market is expecting Snapchat to go through in the near future, all of that has an influence on the implied volatility, or that future expected price range. Now, why is this concept important though? The reason is because implied volatility is baked into the prices of all option contracts. And in particular, the greater the value of the implied volatility, the greater the option prices will be. And then conversely, the smaller the value for implied volatility, the less the option prices will be. So the main takeaway here is it's oftentimes best to use a cover call strategy for stocks with higher implied volatilities. So again, in the case of Snapchat, the IV right now is 87%. That's actually very, very high for an individual stock. So perhaps if you can search for stocks with implied volatilities roughly around maybe 50% or 40% or greater than that, those are the kinds of stocks which will be great candidates for cover call strategies. And just to give you a quick comparison of how implied volatility does affect the prices of options, let's come over to the trade tab now, and we'll go into the February expiration cycle. Doesn't matter for this example here. And so take note of the 40 strike call option. This contract expires in 34 days, and right now it's priced at around $275. But now by comparison, let's take a look at FXI. This is an ETF that tracks the Chinese markets. And as you can see here, it is basically the exact same price as Snapchat, 38 bucks per share. But if we come to the charts, take note of the current level of implied volatility. It's only at 28%. Whereas as you saw with Snapchat, that was over 80%. So now if we go to the 40 strike call option, again in the February expiration cycle, as you can see there, this call option is trading for only about $55. Way less than the exact same call option for Snapchat. So again, this is why you should definitely prioritize stocks with higher implied volatilities, perhaps above 40 to 50% at minimum. Otherwise, the premium that you're going to collect by selling these options is just not going to be that much. It may not be worth it. Now, one final thing in regards to implied volatility. So let's come back to the charts and also go back to Snapchat. So take note down here that I also have this IV rank and IV percentile indicator. Now, depending on the platform that you're using, you may or may not have these as well. But hopefully your platform does have something that will tell you objectively, perhaps with a single number, how high or low the current level of IV is right now for, in this case, Snapchat. Right? Because as I showed you down here, the implied volatility for any stock definitely fluctuates. But you may also notice as well that the implied volatility, not just for Snapchat, but for any stock, typically stays in a pretty nice range. So we could say perhaps on average, right around here, the average level of implied volatility for Snapchat is around, call it 60% or so. And every stock has its own unique average for its implied volatility. And so the reason why I'm showing you this is I also look for stocks where the implied volatility is higher than usual given that particular company. So for Snapchat here, if the average IV is around 60%, then seeing an IV right now of 87, that's definitely higher than usual, much higher than usual. And comparing this level to the past, I definitely don't see Snapchat's IV getting much higher than this. So therefore that means the bottom line here is the prices for Snapchat options right now are among the most expensive that they've ever been. Basically right now is a very, very good opportunity to sell options for Snapchat, because you're going to be able to collect a very, very hefty credit. So ultimately here, putting this all together, look for stocks where on average the implied volatility is above perhaps 40 to 50%, although you certainly can go lower than this. That's just my minimum. And then also, if you can, of those stocks, find the ones where the implied volatility right now is much higher than usual. Now that being said, I will also say that the most important thing is finding stocks with, on average, pretty high levels of implied volatility. The IV rank and IV percentile stuff is just icing on the cake. And also, if your plan is to sell covered calls pretty much every month or every expiration cycle, then you're not always going to have the luxury of waiting for the best moments in terms of the IV being as high as possible. So just keep that in mind too. Okay, so now that I've explained all the reasons why I chose Snapchat as a great candidate for a covered call strategy, we are now ready to begin putting on the position. So the first step here is to always buy 100 shares of the stock. And that's because if you sell the call option first, then your broker is going to think you are trying to sell a naked call option, which is basically just selling a call option and having no stock position as well. Now, this is something that I do all the time with my own trading strategy, but this does require special privileges that you must apply for with your broker. And it's definitely not necessary if you're just trying to do covered call strategies. So again, first step here with Snapchat is to simply come up to the current price and click on that, and then just click on buy. And then down below that brings up the order, and I have by default my buy orders to be with 100 shares automatically, so that's great, 100 shares. And then over here, just to help make the math a bit easier in my examples going forward in this video, let's say I'm trying to buy these shares for exactly $38 per share. So I would set my limit price to exactly 38 and then just go to confirm and send. And then one more thing, as you can see here, the buying power effect for this trade is only $1,140. Now this might seem a bit odd because buying 100 shares of a stock trading at $38 per share should actually cost you $3,800, right? Just 38 times 100. And so the reason why the buying power effect is only about 1,100 for me in this case is because I'm using a margin account. And when you're trading on margin, you actually don't have to put up the full amount of capital to either buy or short stock. But if instead I was trading in a cash account, then yes, I would have to put up the full $3,800. So that's also an important point to keep in mind. And with that being said, I would just hit send, and once the order gets filled, boom, I'm now done with the first step of the covered call strategy. And so that means the second step is to now sell that call option. And once I try to do so, my broker will also see I do have 100 shares of long stock in my portfolio, so therefore it knows I'm trying to sell a covered call, not a naked call option. Now that being said, the first question that comes to mind though is, which expiration cycle should I choose? Right? Because obviously, if we come to the trade tab again, there's tons of different expiration cycles to choose. Some expirations expire in only a week, and some expire in about 2 years. Which one should I choose? Well, I would definitely recommend you choose expirations about 30 to 45 days from the expiration date. And also, I would mostly stick with the monthly contracts. So as you can see here, the ones in yellow, these are the weeklies. And as you can tell by the dates, these come out pretty much every single week. Or basically their expiration dates are separated by only a week, and then you have the actual monthly contracts. So February, March, April, May, so on and so forth. And the reason why I pretty much only trade the monthly cycles is because there's a lot more liquidity with those expirations. Right? So for example, if we open up the February cycle again, take note of the volume for all these contracts here. In particular, the ones that are near at the money. And volume, if you don't know, is simply the number of contracts that were traded in one single trading day, the most recent one. So as you can see here, for the 40 strike call option, over 1,300 contracts were traded in the past trading day. That's a lot. And the volume for most of these contracts is in the hundreds or the thousands. So again, what I'm seeing here is very good liquidity. You're going to be able to get in and out of trades at very good prices and also just simply very easily. There's basically always going to be someone willing to take the other side of your trade. And then by comparison, if we go to the February 25th weekly cycle, let's unfold that tab and then have a look at the volume for these contracts. They're all way, way less. So again, most of the time, the monthly expiration cycles are going to have a lot more trading activity. They're going to be a lot more liquid than the weekly cycles. And then the reason why I suggest you use expirations between 30 and 45 days from expiration is because around that time, that's when time decay starts to really accelerate. And if you're not familiar with the concept of time decay, it is simply the fact that as time marches forward, the prices of all option contracts will lose their value. And that's going to be a good thing for you as an option seller when you sell that call option, because if you ever wanted to buy that contract back before expiration and simply close out that portion or that piece of the covered call, ideally you'll want to do so for a lower price than where you sold the call option at the beginning. So for example, if you sold the call option for $200 in initial premium, and then a few weeks passed and time decay reduced the value of that call option by 50% down to only $100, well, at that point, you could buy the contract back for a debit of 100 and make the difference in those two prices as your profit. So 200 minus 100 is $100. That's your profit. And like I said, around 45 days or so, that's when time decay starts to really accelerate. Okay, so now that we've identified which expiration cycle to choose, and for this case with Snapchat, we're going to go into the February expiration cycle with 34 days left to go. The next question is, which strike should I pick? Right? Because obviously I can sell any one of these call options here. Now, before I can answer that question, I do also have to introduce the concept of cost basis. And your cost basis is basically your current carrying cost for the entire position. So basically, when I first put on this covered call position and I bought 100 shares of Snapchat at $38 per share, that initial cost, $3,800, that is my initial cost basis. And as you'll see throughout this video, it's actually more useful to look at your cost basis on a per share basis. So again, for Snapchat here, my initial cost basis is $38 per share. But simply the purchase price of the stock is actually not the full picture of the cost basis. The true definition, or I should say the true equation, is your stock purchase price minus the total premium you have collected. Again, all on a per share basis. And don't worry, I'll show you examples of this in a second here. So basically, when it comes to picking your strike, you ideally want to pick your strike to be at or above your cost basis. So again, here, if I bought Snapchat at $38 per share, then sure, I could pick the 38 strike call option and sell this one. But honestly, I would not recommend this because you will almost certainly get assigned on this call option, and also your profit is not going to be that large. It's actually much better to sell a call option a bit further away, because that allows some nice room for the stock price to increase a little bit before breaching your call strike. And as you'll see, allowing the stock some breathing room to increase in value, that's going to make your maximum potential profit on the covered call bigger. So perhaps in this case, I want to sell the 42 strike call option. This one gives about $4 in breathing room for the stock to increase from 38 to 42. And then also, I can still collect a pretty decent credit for selling this call option, about $205 or so. And one more tip here to help you pick your strike: the further out that you choose in terms of your strike, the more and more bullish you are with this position. So if you are super bullish on Snapchat, then perhaps sell maybe the 46 strike call option. You'll collect less premium for doing so, but now you're giving Snapchat a lot of breathing room to increase in price. And the more breathing room that you provide, the greater and greater your maximum potential profit will be. But again, for me here, if I were to put on this position, I would probably choose the 42 strike. So at this point, I can click on the bid price for this option, and that brings up the sell order down below. Just going to sell one contract because again, I only bought 100 shares. So basically for every increment of 100 shares that you buy, you can sell one contract. So then over here, I'll try and lock in a price of maybe $205. Then go to confirm and send. Now, because I am filming this video on the weekend and the market is closed, so therefore that buy order for 100 shares has not gotten filled yet, that's why you are still seeing some buying power effect for this trade here. So right now my broker still thinks I'm trying to sell a naked call option, right? It's only once your buy order for those 100 shares gets filled, once those shares are in your account, only after that point when you try and sell a call option is your broker going to think that you're trying to sell a covered call option, in which case the buying power effect here would actually be 0. But still, for the sake of example, pretend this is 0, so therefore I would just hit send. And there you go. So once that order gets filled, I would then be completely in the covered call strategy for Snapchat. So now at this point, let's fast forward all the way to the February expiration date and discuss what would happen. So again, keep in mind, I bought the shares at $38 per share, and I sold a call option with a strike of 42, $4 above my purchase price. So now let's say come expiration date, Snapchat has increased in price from $38 per share to $41 per share. And so because the stock has not breached my call strike, that call option is still out of the money. It would therefore simply expire worthless. It just disappears. But I would still get to keep and walk away with the full $205 that I sold the call option for at the very beginning. That's very nice. And that premium now reduces my cost basis. As I explained, the equation for your cost basis is simply the stock purchase price minus the total premium that you have collected. So because at this point I've only sold one covered call option, my total premium collected is only $205, which on a per share basis, if you divide that by 100, is $2.05. So that means now my cost basis is $38 minus $2.05, which is $35.95. So now this means if I did not sell another call option, let's just say I continued holding the shares and that was it. This means now Snapchat can fall down in price to a value of $35.95. And if at that point I decided to sell those shares and get out of the position, I would simply break even, right? Because the full picture here is if initially I bought the shares at $38 per share, and then at some point down the road, I sold them for a loss at $35.95 per share, that means I lost exactly $2.05 per share on the stock. But don't forget, by also selling that call option and collecting and keeping a premium of $2.05 on a per share basis, the net result is I don't make or lose any money. I simply break even. So hopefully that example gives you a very clear picture of how your cost basis actually works. It can also be viewed as simply the lowest price the stock can fall down to, where if you sold those shares at that point, you would simply walk away from the trade, breaking even. But now in a different example, let's say we fast forward again to expiration, and now Snapchat has increased in price not to $41 per share, but all the way to, let's say, $44 per share. So now because in this case, the call option that you sold has now expired in the money, Snapchat is above the strike price. At this point, you are very likely going to get assigned on the call option. And when that happens, you as the seller of the option must sell 100 shares of Snapchat at the strike price at $42 per share. So even though Snapchat has increased to $44 per share by expiration, that does not matter. You must sell them at 42. But that's still a good thing because as you saw initially, we bought the shares at $38 per share. So buying at 38 and selling at 42, that's going to make a profit of $4 per share. Times 100 shares, that's a profit of $400. Very nice. And then on top of that, you still always get to keep the premium that you sold the call option for as well. So in addition to that $400 in profit on the stock, we also add to that the $205 in premium that we sold the call option for. And so that makes the total profit $605. Awesome. And this is actually the maximum profit situation. The way to make the most money on a covered call option is for the stock to actually increase through your call strike. And a simple equation to calculate your max profit potential is simply take the strike minus the purchase price of the stock, then multiply that by 100, and then add to that your call premium. So again, the strike is 42 minus the purchase price of 38, that's 4. 4 times 100 is 400, plus the call premium of 205. And again, that gives the maximum profit potential in this trade here of $605. Now the next step, if you wanted to continue the covered call on Snapchat, would be to simply repeat the process. So in that case, you would now come to the next expiration cycle, which would be March, and then you would just sell a new call option. Although just to be clear here, if you did actually get assigned on the previous call option, then now the first thing you would have to do is buy 100 more shares and then sell this call option in the March cycle. And also in that case, your cost basis gets reset to the new purchase price of those 100 shares. So primarily, when I talk about continuing the covered call strategy, I'm mostly referring to the situation where the call options that you're selling expire worthless and you still have the 100 shares that you bought at the very beginning. But once you lose those 100 shares through the assignment process, then the entire cover call strategy basically resets. So in the case where that February call option does expire worthless and you still have those 100 shares, your cost basis is no longer the $38 per share that you initially bought the shares at. Now it's down to $35.95 on a per share basis. Now that being said, your cost basis really only becomes very important if the stock price actually plummets drastically. So for example, if after February expiration, let's say Snapchat fell down to a price of $30 per share, maybe they had a really bad earnings announcement, well, at that point, you have to be very careful with which strike you choose. Because let's say at that point for the March expiration cycle, you decided to sell the 32 strike call option and perhaps you collected about $200 in premium. Well, that additional $200 will reduce your cost basis a little bit more from $35.95 down to $33.95. But now if Snapchat recovers and blows past your short call strike at 32, and if you get assigned on it by the expiration date, well, at that point, you're going to have to sell your shares at only $32 per share, which is below your cost basis of $33.95. So that means you would actually walk away from the position with a net loss. Now, sometimes, as I'll discuss a bit later, you have no choice but to do that if it's more of a damage control situation. But most of the time, if you think the stock will recover, you definitely have to keep your current cost basis in mind. You don't want to be in a situation where you sell a call option with a strike too low, and then you get assigned on it and have to sell your shares for an overall net loss on the entire cover call position. Now, one thing you can do to avoid assignment on your call option for any situation, whether it's to avoid selling your shares for an overall loss if you mistakenly sold a call option too low, or if you simply want to hold on to your shares for a while longer, now I introduce the concept of rolling. And so the idea here is to roll your contract out in time, which basically means you're going to buy back your initial call option and then sell a new one with the same strike or perhaps a slightly different strike, but in a further dated expiration cycle. And as long as you don't change your strikes too much, you will always be able to do this for additional premium or additional credit. And then, of course, also 99% of the time, you will avoid assignment. So for example, if we come back to the February expiration cycle here, this was our initial trade for the cover call on Snapchat. And let's say there was only a few days before expiration and Snapchat was up to $44 per share. So therefore, there's a pretty good chance that you're going to get assigned on this call option and have to sell your 100 shares. So again, if you wanted to avoid that, what you'll have to do is buy back the contract. So here we go. This is the order to buy back the 42 strike call option. And then in the March expiration cycle, which if I unfold the tab here, I would sell the same or very similar strike call option. So for the sake of simplicity, I'll sell the same strike, 42. So then I'll click on the bid price for this contract. And then here we go. Just to show you this by comparison, same strike call option. Only difference is the actual expiration date, and the prices here are very different. So if I buy back my February contract for some debit, I will always be able to sell the same exact contract further out in time for more as a credit. So the difference here is 65. That would be the additional premium I would collect on a per share basis, 65 cents. And that would, of course, reduce my cost basis a little bit more. And then, like I explained, it would also avoid assignment. The vast majority of the time, you will only get assigned on a call option that you sold, which is in the money, either super close to the expiration date or most likely on expiration day. It almost never happens like a few weeks before the expiration date. It's certainly possible, but again, it almost never happens. And you can keep on doing this perpetually if you want to. You can simply keep on rolling your contracts out in time again and again and again and just collect more and more additional premium. This is basically the second way to do the cover call strategy. Whereas with the first way, you can simply take assignment if that ever does happen, and then basically reset and buy 100 more shares, sell another call option, and just repeat. So it's pretty much up to you to decide which way you want to do it, or if you kind of want to mix and match with these two different approaches. And then finally in this video, the last thing I want to talk about is the main danger with the cover call strategy. And that is you still have naked downside risk, meaning if the stock totally plummets, then you will certainly have very large losses on the position. And in fact, if it drops too far, you may not be able to sell more call options above your cost basis for hardly any premium, which would basically render the covered call worthless. And so in such dire situations, you may be forced to sell call options below your cost basis, simply to reduce losses. As I explained, this is basically a damage control situation. If there's no way to profit on the position other than simply holding the shares for as long as possible and maybe the stock recovers, then perhaps consider trying to simply reduce your losses as much as possible. And also, the best way to keep your losses in check, even if the stock goes to zero, is to simply keep your trade size small on entry. Basically, don't allocate your entire account or half your account for a single covered call position. Right? For example, if your account here was only $5,000, then buying 100 shares of Snapchat for $3,800, that's almost 80% of your available capital. So that is way too large of a position for your account size. Ideally, if possible, try and keep the total capital that you allocate for one position, for a covered call in this case, between 5 and 10% of your total account value. You may have to go a bit beyond that if you do have a smaller account. Sometimes you don't have a choice but to do that. But again, the best way to defend against some massive losses on any one position is to simply keep your positions small to begin with. 9 times out of 10, the main reason why a new trader blows up their account is simply because they were trading too big. And so with that being said, that's going to conclude this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my Skillshare courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.